set up all the
employee benefits, consulting, small and mid-sized companies. Thank you.
Good afternoon, everyone. We're going to give it just a couple more seconds so everyone can get their seats, and then we'll get the show on the road here. Okay. Well, thank you so much, everyone joining us. New venue this year. Welcome to our homestead. We purposely chose this time to have our economic forum because we had an idea what was going to happen. Just kidding. We didn't know. No, but what a time, right? At times, everything's just going along nicely, and then you have these sudden bouts of volatility. And I couldn't think of a better time than to get Dan Laufenberg, our economist, in front of our friends, partners, and clients. So I think it's going to be a very fun afternoon. The question was, does Dan feel the same way about being in front of us? No, look, this is not Dan's first rodeo. While we are in somewhat unprecedented times, bouts of volatility do happen in the markets, and so we're pleased to get in front of everyone. This is going to be very exciting, very fun. So what we're going to do right now is I'm going to bring Dan Laufenberg up in just 1 second. Dan's going to speak and give his economic address. My name is Mike Dashner. I recognize most people out in the audience. I run the equity team at Stonebridge. I'm going to give a brief update on the markets and how we're navigating this very interesting atmosphere with regard to equity strategies. And then Jon Lynn is going to follow up with our fixed income strategy and a brief overview of the fixed income market. We're going to circle up after everyone's done speaking with a Q&A. And please don't hold back. This is what we got in this business for, and we reserve plenty of time for questions. So that's where all the fun is anyway. So let me get Dan up here. For folks that don't know Dan, he's been with Stonebridge as our chief economist for 16 years now. Prior to Stonebridge, Dan was a chief economist for Ameriprise, formerly IDS, American Express, and Dan started his career with the Federal Reserve. So he has a long, colorful career, both on the government side and the public market side, giving the most unique insights to what we're dealing with right now. So with that said, Dan,
thank you, Michael.
Take it away.
Thank you, sir. Thank you. He was running through my resume, and I was thinking, I'm old. And the fact is that it isn't a new event. It's slightly different from some of the other experiences that we've had over time, but I've been in this business long enough to live through a bunch of these. So I'm going to start by not telling you a joke today, because I don't think this is a situation that necessarily requires a joke, although we wish we had one. I'm going to start by telling you what I think is going to happen. But I'm going to talk about it in sort of vague terms because it's really difficult to give you any kind of a detailed forecast in this kind of environment because things change quickly. I don't know if anyone reads my economic outlook that shows up on the website, but I published one on March 27th, and then I had to publish another one on April 7th. So I could have another one today, but I'm not. What I'm going to do is I'm going to say, if you're looking for a detailed forecast, I recommend that you read both of those and then try to find a place somewhere in between the two for what's likely to happen, because that's what we're going to talk about today. First of all, the economy is going to slow down in 2025. It's going to be far slower this year than it was last year. Is it going to be a recession? I don't know if it's going to be a recession. If we get a return of tariffs like the ones that were paused, it's definitely a recession. But the question that I have is, are the tariffs that are still in place enough to get the economy to go into recession? It's going to be a close call. I would say we're on the brink. And any little thing could tip that one way or the other, but it's going to be a situation where the economy actually contracts for at least 2 consecutive quarters. Now, the last recession we had was the one during the pandemic. It lasted 2 months. That's the shortest recession on record. Average recessions are somewhere around 10, 11 months. So if it's an average recession, once we go into it, it's going to only take 10 or 11 months to get out of it. It's going to feel like forever. You're going to have all kinds of issues. It's going to be painful. especially for those people that are directly affected by recessions by losing their jobs or losing their source of income or losing some of their assets or whatever it is that inflicts the pain on you. Those are the ones that are going to suffer the most. So recessions are not fun. What I think might be a little different this time is that if the tariffs remain in place or if they are reinstated, then it's not going to be just a recession. It could, in fact, be stagflation, a situation where the economy is actually contracting, but prices continue to go up. In a typical recession, when the economy goes in recession and people lose their jobs, prices tend to start to pull back a little bit. Things slow down. People aren't buying things, so retailers have to cut their prices. Businesses that aren't able to operate in that kind of environment close. So you have to come in with new technology, new processes that make goods and services even cheaper than they were before. That's sort of that creative destruction that recessions provide. It gets the people that aren't really efficient enough to survive out of the business and the people that are more efficient to come in and start business or to continue business. So that's what generally happens. Prices tend to respond in that way. Now, this time around, because of the tariffs, it's a little bit more of a supply side shock than it is a demand side shock. So if it's just demand, if it's just because people were spending too much and we were just going crazy and prices went up, not too different from what happened after the pandemic, that's a little different in a situation than what we have now, where we actually have tariffs, so it may affect supply, may actually push us on the supply a little bit more than we would normally. And it's not going to be like we had before, where it just sort of one-off. It's going to be longer. It's going to last longer. It's going to take longer for that transition to take place. So that's why it's going to last a little longer, if it is a recession. If you pushed me on it right now, if you pushed me today, and it may change tomorrow, right? But if you push me on it today, I would say, yes, we're probably going to go into a recession. And the reason I think we're probably going into the recession is two reasons. I have two models, two little indicators that I use to help drive my forecasts. They don't make the forecast, they just sort of influence me in how I make the forecast. And these two models both are suggesting that a recession is either here or nearly here. And so that makes me think that maybe a recession is probably more likely than not. But right now, that's all I'm going to say, is the economy is going to be a lot slower this year than it was last year. You're not going to get 3% growth. You're going to get something probably around 1% at best, but probably less than that, and in the worst case scenario, probably negative. You don't have any growth at all. So that's sort of where we're at. In that situation, because we have slower growth, because the economy is going to grow slower than our potential, the unemployment rate is going to go up. So how much does the unemployment rate go up? I have no idea right now. I have no idea. It depends on how much of a slowdown we get. If we get a dramatic slowdown, the unemployment rate is going to go up a lot faster and it's going to go a lot higher. If it's a relatively slow and moderate recession, then the unemployment rate is probably not going to go up that much. I say it's going to be average in length. I think it might be also be average in its level of severity. So maybe we don't lose as much GDP as we did the last time during the pandemic in that short period of time, or we don't lose as much in GDP as we did during the financial crisis. But we do lose sort of average, so it does contract, it is painful, and we lose jobs. But you have to remember that the labor statistics are a lagging indicator. So the unemployment rate doesn't go up right at the very start. You know, it might tick up a little bit. Right now, the unemployment rate is, what, 4.2%? 4.2%, I remember when full employment was 5%. We thought the economy was at full employment when the unemployment rate was 5%. We're at 4.2. Are we in a recession? No. The National Bureau of Economic Research would never say we're in a recession with the unemployment rate at 4.2%. What's going to happen to the unemployment rate? I think by the end of the year, it's going to get to 5. But it's going to take the whole year almost to get to 5. And that's not very high. You say, well, gee, 5, by old standards, that's full employment. Why are we worried about it? Well, because that doesn't stop at 5. It's on its way to 6. And because the employment data is a lagging indicator. The unemployment rate doesn't start up right, but once it starts moving up, it goes up fast. When the economy is going down, it moves up even more. And by the way, the unemployment rate has a tendency to peak, to be at its highest level after the recession is over. The recession has to be over before the unemployment rate peaks. It's not until you get to that point up there that it peaks. That after the recession that it peaks. So when did the unemployment rate peak at, 12% during the financial crisis, 2007, 2008, 2009? It got to 12%, unemployment rate. It peaked after the recession was officially over. Now, who tells us when recessions start and recessions end? Well, that's the National Bureau of Economic Research. Is that a government agency? No, it's not. It's a group of economists, heaven forbid, right? It's a group of economists that go through all this data that they have. It's not just one number, not just one statistic, but it's a host of numbers, and they tend to be dominated by employment and income data. Those are the ones that really drive it. Now, real gross domestic product is one of the factors that matters, but it's not the most important one. Because, you'll hear from people who say, well, what's the definition of a recession? Recession definition is if you have 2 consecutive quarters where real GDP goes down, that's a recession. Well, wait a minute. The first 2 quarters of 2022, what did real GDP do? Went down. Well, that's not a recession. Why wasn't it? Because the unemployment rate hardly moved at all. Income was still growing. The economy went down because the Fed was raising rates. We had a little bit of a pullback. People were worried that it was over, but it wasn't over. It just continued. And the National Bureau of Economic Research, the group of economists that said, that determined whether it was a recession, said, no, it's not a recession. Even though by that envelope, back of the envelope definition, it certainly was. You had 2 consecutive quarters where real GDP declined. The market went down. You had a 25% drop in the stock market during that time. You had a lot of stuff going on. So if it's income and employment that really sort of drives whether or not it's going to be a recession. So unemployment rate is going to go up. Here's the ticker here. The real ticker to this one is that inflation is probably going to stay elevated and may even go even higher, again, depending on what happens to tariffs. Tariffs are really important here because, by the way, the final burden of the tariff falls on us. We're the ones that are going to pay for it. Maybe not the entire tariff, but most of it is going to be paid by us in the form of higher prices. Because if you have a company that's importing goods from China, right? We'll use China because we have a tariff of 125% on China, which means that every good that comes in to the U.S. from China is going to double in price, more than double in price, right? To the wholesaler, to the guy that's bringing it in, to the importer. He's going to have to pay the price to China for the good, and then he's going to have to turn around and pay the federal government another, whatever it is, another price. So it's like $50 here, $50 there. So it's going to cost the guy that's bringing it in, the importer, $100. Who's going to pay that $100? The consumer. When he goes around and sells the product, whether it's to a consumer or whether it's to a business, because it's one of their inputs that they use for their production process, it's going to go to them. Its cost is going to show up there. That's where the cost is going to be. And eventually, they'll pass that on to us as consumers. Whatever they're producing, they're going to sell here, and we're going to have to pay the higher price. So it passed through. So it's not paid by anybody else, it's paid for us. Now, there's 2 ways to sort of deflect a little bit of that. One, if you can convince the supplier of the goods in China to sell that good to me at a lower price, then I won't have to pass, the tariff will be less, its tariff will be 125%, but it'll be at a lower price, it'll be off a lower base, and it won't be quite as high. You get them to take a cut. But that means they're going to cut their profit margins, and they're not going to make any money. Wait a minute. How willing are they going to do that? Not very, given the way things are. The other one is if the company that's importing the goods decides to take a hit to their profit margin. Let's say that Target is buying these goods from China, and they're putting them on their shelf, all right? And instead of upping the price to 125%, they will say, okay, as Target, we'll take a little bit of that hit. We'll cut the price less than 125%, and we'll take a lower profit margin on it. But that only lasts for a little while, because at some point, Target's going to say, okay, enough is enough. It's time for us to bump the price up. So what it does do, it probably eases the price increases through this whole thing. And so you're not going to get 125% right off. It's going to be less for several reasons. Well, you might be working out of inventories, so you're not really importing that high-priced item yet. And then it's going to work its way up, and it's finally going to be higher. So I have inflation staying elevated. In fact, I would argue that inflation is probably going to tick up through this year. Now, now that said, we got a consumer price index number that was reported this morning. The consumer price index fell 0.1% in March. Why? Because gasoline and oil went down. And what else? Oh, airline tickets went down, supposedly. Right? It wasn't in my basket, but maybe it was in yours. So anyhow, those two things caused the CPI to decline, overall CPI to decline. The core, if you exclude food and energy, oh, by the way, food prices are up 5%, 0.5%, so there's a nice big increase. That's big for 1 month. At an annual rate, that's 6%. Thank you. I had to think a second. I have to think occasionally. I'm not like a lawyer where I can talk without thinking. I'm sorry. That was nasty. Anyhow, the point is, now I have to think. I didn't want to get personal. So anyhow, the inflation is going to go up. It's going to be higher. It's going to be ticking up, and it's in first quarter, the CPI, even with that 0.1 of a decline in March, the consumer price index for the first quarter, if you average the indexes for the first quarter, the first 3 months of the quarter, they were up 3.5% or 3.8%, from the fourth quarter. Even with that 0.1% decline, 3.8% increase. So consumer price indexes in the first 3 months of 2025 were up 3.8%. Right? That's not disinflation. That's a sign that things are going to go. And I would argue that now that the tariffs are in place and they're going to have more and more of those effects working their way through, that inflation in the second quarter is probably going to be at least that high, if not a little higher. So I got to show you the math. I'm sorry, I got to do it. It's details, but I got to tell you. Even though it was down 0.1% in March, the March level of the CPI is still above the average for the quarter. And so that means that whatever inflation we get in the second quarter is going to be whatever the inflation rate is for April, May, and June. And I would argue that those are 3 months that are going to be affected, at least partially, by whatever tariffs are already in place. Because we still have a 10% tariff on everything. We still have a 125% tariff on China. We still have 25% tariffs on autos and steel and aluminum. And President Trump just the other day talked about putting a tariff on pharmaceuticals. So these are tariffs that are going to come and hit us directly. Okay, inflation. Enough about inflation. Interest rates. What are interest rates going to do in that environment? What is the Fed going to do if the economy slows down and inflation stays high? What are they going to do? Well, raise rates. Some would say lower rates. In fact, a lot of Wall Street firms are talking now, they were talking about no rate hikes. Now they're talking about, or cut no rate cuts. Now they're talking about 4 rate cuts. So they're going to cut rates rather than raise rates. A lot of Wall Street firms, right? That's sort of ironic because if you read my first piece in March, I said the Fed wasn't going to do anything. And if you read my second piece in April, I said they're going to cut rates 4 times, right? Because I thought no, I'm sorry, the other way around. I thought they were going to cut 4 times in March, because I thought the economy was going to slow and we weren't going to have this inflationary shock, so we weren't going to have stagflation. But in April, we had no rate cuts. We have the Fed doing nothing. And I think that's what the Fed is going to have to do, at least nothing, right? They can't cut, they'll do nothing, because I was on the staff of the Federal Reserve Board in Washington, D.C., research staff, in 1973. What happened in 1973?
We got married.
Congratulations. God, now I am old. You're youngsters.
It wasn't a huge economic event.
It was scary to me. 1973, it was the first oil embargo. Oil prices shot up. Inflation, stagflation. The economy went into a recession. It was one of the worst recessions we had up to that point. It was ugly. And I had just started at the Fed. I mean, it was awful. I had to ride the bus to work, which wasn't bad, right? But we only had 1 car, couldn't afford 2. My wife had the car. Her job was to get in line to get enough gas, to get a full tank of gas to last us the whole week. So she would get in line, and she would be in a gas line for 2 to 3 hours, waiting to get a tank of gas that we would use for a week, and then she would go and get in line the next week and do it again. That was her job, with our little daughter who was sitting in the back seat all this time. Yeah. That was an episode that I started at the Fed, and I remember it because I was fortunate enough to be invited to go to a conference meeting that the Fed was having, and they invited in all these famous economists, almost all of which eventually became Nobel Prize winners in economics, to this meeting. And I was sitting in the cheap seats, listening to what was going on. And it was amazing, the discussion that they were having about what the Fed should do with monetary policy in this environment. Should they be lowering rates? Should they be raising rates? What should the Fed response be to a stagflation environment where the economy is slowing down and prices are going up? What do you do? I'm betting the Fed's having the same debate now. They don't have those same economists around to advise them, which is probably a good thing, because they didn't know either. But I think what the Fed will do is the Fed is going to say, okay, we're not going to do anything. We're going to wait, and we're going to wait and see which one wins out. If inflation is the one that survives this thing, then they're going to raise rates. But if it's unemployment and the economy going into recession and prices start to come down a bit, they start seeing a little, not declining prices, but disinflation, where inflation is coming down, then they start cutting rates. So I do expect the Fed probably will cut rates at some point, but not right away. They're going to wait. And they're going to be wrong. They're going to be late. They're going to be late because they are going to wait. They're not going to anticipate anything. They're going to be late. And that means that we're going to be in a recession before they decide to cut rates. That's sort of how it works out. Long rates, because of inflation, long rates are probably going to be steady to up. I think you're probably going to see longer rates move up. So in my last report, I thought long rates would go up more than I think now, because we got a 90-day pause. If at the end of that 90 days, we get all these tariffs reinstated, or if something happens between now and then that changes the tariff story, then maybe we get higher rates, even higher than what I might be thinking right now. But higher rates, higher long-term rates would be my bet. All right. What else? Corporate profits. Corporate profits, to the extent that businesses are going to suffer in terms of higher prices, higher cost of inputs, having to try to sell goods at a higher price, losing sales as a result, you're going to see corporate profits probably suffer in this environment. How much? I don't know, but I would guess that corporate profits per share on the S&P 500 by the end of this year will be less than it was last year. It's going to be down. And I think the stock market is telling you that. The stock market has corrected quite significantly. And I would say that it's not, it's not the end. I think it could go down. I don't think we've seen the bottom just yet. Despite President Trump telling you yesterday it was a good day to buy, just before he announced that tariffs were going to be on pause. If anybody else did that, they'd be in jail. Martha Stewart would probably agree. Okay. What else am I doing? I guess that's the story. That's all I have, really. I'd like to give you a few other lessons. You look like a classroom here with these tables and chairs. I feel like I should have some slides. I should draw some things on the chalkboard. But I think I'll give it over to Michael.
Thank you. Good job. Well, Dan, thank you for the rosy economic outlook. Now my job is to explain how we invest in that. There's a lot we could say. We were going to have some charts up, but every 15 minutes we said, well, that chart's no longer useful. So the market's moving quite a bit, and if it feels like it's volatile, it's because it is. Friday, we broke a record on shares traded in U.S. Stock Exchange that went back to 2021. We broke that record again Monday, and we just broke that record Wednesday. So things are moving around. Now, I've been up in front of you folks for the last couple of years now saying the same old thing, and fortunately or unfortunately, my message hasn't changed. When you look at the themes of the market and what's driving performance, it's 180 degrees different than what drove performance last year. But most important, our strategy hasn't changed. We're fundamental investors, and when it means to be a disciplined investor, you have to be disciplined when times are good and when times are bad. I am a little more optimistic than Dan because I am an eternal bull, and I always look to the equity market, but I understand things don't go up all the time. And all of our pieces we've written in the last couple of years, it's been things are going up and things are great, but we're not chasing things we don't understand. At times that's difficult when your peers blow by you in performance because they pile into the momentum stocks and they get big and they continue to grow. And Ron Hume and I were looking yesterday. In 2024, the market hit 57 all-time highs. More than once a week when you'd come into work, the market's at an all-time high. That's something we can get used to, by the way, and I think a lot of people did get lulled to sleep. But that's not reality. The market goes sideways, the market goes down, and in most years, the market goes sideways, up and down. And we don't get to choose which environment is going to happen tomorrow, but there are things we can control. We can control our asset allocation, and I'm happy to note for the first time in quite some time, bonds are actually quite attractive. I'm not going to steal Jon Lynn's thunder. He's going to talk about bonds here in a second. So we can control our asset allocation. We can control how much we want to put in the market, how much we want in the bond market, how much we want in cash. We can control our position sizing, which means how much do we want to put in any one company. And this goes back to what I was talking about from last year. The Magnificent Seven, which I swore I wasn't going to talk about today. The Magnificent Seven, at one point in time, 7 stocks in the S&P 500 made up 36% of the index. That's like if we were to take your portfolio and your entire equity allocation is in 36% of it's in 7 stocks. We don't do that. And it hurt our performance last year on the upside because we didn't own the largest companies to that degree. We owned 6 of the 7, depending on the strategy. And we've had good exposure to the Magnificent Seven, and it's helped performance considerably over the last several years. But we didn't own it in the same percentage that's represented in the index. And so that hurts on the way up, but we stuck to our knitting, and we didn't chase momentum. Now, fast forward to the first quarter, Mag 7's down 28%. The overall market's down 12%, depending. It was down 8.5% this morning. Then it was down 12%, and then when we came down here, it's probably down 11% year to date. Something close to that. So disciplined investing has to work on the way up, and you have to stick with it on the way down. Now, moving forward, where are we at? Dan said we might have a recession. We are probably likely to have a recession. We're always likely to have a recession. Markets don't go straight up. So when we're building portfolios, when we're building asset allocations, I was talking about the index, and a lot of passive investors, their benchmark and their mandate is the index. Our benchmark, our mandate, are individual investors' objectives and risk tolerance. And so we let that govern what markets we invest in, how much we have allocated toward stocks, how much we have allocated toward bonds, what type of stocks we own. And when the index bottoms, not every single company inside that index bottomed at the same time. In fact, right now, we're getting the buying opportunities on the number of stocks we wanted to buy for the last 2 years. We're not making huge allocations. We're not jumping into these companies both feet. We're taking bite-sized chunks along the way. Because for the last 2 years and everything we wrote, we kept saying, gosh, we'd wait for that. We would love that pullback again so we can swoop up on these companies we saw run right by us. Well, we have that pullback now, and it might last for quite some time. Or we could have one of those V-shaped recoveries where you blink and you missed it. We can't control that. But what we can control is we take a look at all the names we follow every single day when we come in, and we say, there it is. And if we keep focusing on hitting singles and doubles, at the end of the day, we win. Now, I'm going to hand this off to Jon Lynn, but I do want to put things into perspective for just a little bit. Just in the last 5 years, we've had COVID. Extremely scary for the financial markets. We shut down the global economy. We had a tremendous market pullback in 2022 when the Fed started raising rates. And that was actually quite scary because we basically came off the bond market when the 10-year was at 80 basis points. And so there was no shelter to be had. And now we're in another once-in-a-lifetime event with this market sell-off. But through each one of these events, we came out on the other side typically better than where we started with our portfolios because we stuck to a disciplined approach. And I have no doubt this time will be the same outcome, but the variables are a little different and we have to understand that. So we're fundamental investors. We look at cash flows. We look at balance sheet health. We look at income statements. And like Dan said, if corporate profitability is going to change, all right, we need to adjust how we're looking at companies. And while we can remain with the same set of tools we use, we do have to change with the times. But that doesn't mean our philosophy changes, and that doesn't mean our discipline approach changes. And in fact, we use this volatility to add to the positions we like and pick up names we don't already own. One last thing, because I did talk about these once-in-a-lifetime events. John Schoenberg, our CIO, we had an epiphany today. We've realized since I've been around, since I've been born, we've had no less than 5 once-in-a-lifetime market events. And so given what the average life expectancy is, I believe today I celebrated my 385th birthday. So I may look young, but according to statistics, I'm quite old. Just kidding. Dan said he didn't have any jokes. I had to throw one out there. He usually is the comic relief, so I had to patch one together there quickly. So long and the short of it is we would love to get your questions after Jon Lynn talks about the fixed income market. But things are a little different this time, but they always are. We never know what leads the volatile events because that's what systemic risk is. If everyone knew it was going to happen, you wouldn't have these huge shocks in the market. They hit us when we least expect it. And so we have to plan for events that we didn't see coming, and we do that with appropriate risk planning. It's getting to know our end investor. It's understanding what your true risk tolerances and investment objectives are, and that's how we build the holistic portfolio. And that's how we can control what we can control, and we can't control what goes out of DC. So, Jon Lynn is the head of our fixed income. He gets to talk about bonds, which are much more fun to talk about right now than the equity market. John's been at Stonebridge for 18 years. He's a member of the Minnesota Society for Municipal Analysts. He was the former chair and president. He brings a lifetime experience of particularly municipal bonds and then corporate and taxable bonds as well. So, Jon, we would love to hear your insights on the bond market. Thank you, everyone.
Well, thank you, everybody, for being here. I know that there's a lot going on in the markets right now, so I'm going to try to make my comments really as brief as possible, just because I know everybody's got a lot of questions for Dan. and Mike, hopefully. As Mike said, not every year when we get up and do this is it easy to talk about the bond market. This year is a little bit easier because interest rates are a lot more favorable. But I do kind of want to put things into perspective because we have been living the last few years in really a higher interest rate environment, but that hasn't always been the case. If we go back to really the decade prior to the pandemic, we were living through a zero interest rate environment. And that was the 10-year US Treasury averaged about 2% during that time period. Sometimes it was a little bit above that, sometimes it was a little bit below. But when you looked at ultra short interest rates like the 3-month T-bill, which is kind of a proxy for what you're going to earn in your savings account and your money markets, that was zero. Now it started to tick up a little bit as we were moving towards 2019, but once the pandemic hit, the Federal Reserve lowered short-term interest rates. We saw a big flight to quality on longer-term bonds. So even Mike kind of alluded to where we were on the 10-year, it bottomed out at about 0.5%. So we lived a couple of years where it was just a real challenge to earn any interest or any income on money markets or fixed income. So that was very challenging. Throughout that time, our strategy really was focus on high quality borrowers, whether that's corporations or municipal bonds, those issuers. And then also to keep our duration much more moderate, and that was shorter, keeping maturity structures shorter. And what that has an effect on doing is when you do see interest rates rise, then it cushions the portfolio and it protects your market value a lot better than if you were to max out and say buy 30-year bonds. So as Ron would say, we kind of hit it out of the park with that strategy. It worked really well. But going into 2022, when we started to see interest rates rise, we had to shift gears a little bit. We didn't really change our approach as far as focusing on high quality issuers. We did focus more though on longer duration. So we started to extend out a little bit more, not going wild, I'd say, much beyond about 7, 8, 10 years. That was kind of our max. But being that the yield curve was relatively flat during that time period, we were still buying shorter maturities, and we were picking up relatively the same yield. Because remember, for fixed income investors in bonds, we're really looking at two things. Not so much performance, but we're looking for generating income and setting up a schedule of your return of principal over time so that you have principal being returned to the portfolio that you can either reinvest at higher rates or maybe shift that into the equity market if prices are lower and you need to reallocate to meet your risk tolerance. So really we've spent the last several years getting portfolios really right-sized with where they should be. When you're in a low interest rate environment, it's very tempting to move into dividend stocks and your allocation can get a little bit out of whack. But the last few years have really given us a great opportunity to rebalance portfolios. The one thing that I will say, I'm really kind of specifying individual bonds here, but for folks that use bond ETFs as part of their fixed income allocation, we really had sort of the same shift in strategy, not necessarily outlook, but for a lot of years we have been using maturity-specific ETFs, and that is if you invest in, say, a 2025 maturity-specific ETF, in 2025 you're going to have all of your principal returned to you. So it really works the same way that an individual bond does, just it's an ETF. But over time, the last few years, we've really moved those maturities into a fixed duration, a little bit longer term ETF. So you might have seen those changes in your portfolios. So I mentioned that interest rates are high now. Our strategy really isn't changing based on the volatility that we're seeing. we look at higher interest rates generally as an opportunity for us on the fixed income side. Dan laid out a few risks to the economy and his outlook that he sees, essentially stagflation, a recession, and he really was talking about some of the points that I wanted to make here. So this will be good to kind of reinforce it. On the bond side, we look at a recession. Obviously it's going to be something that we're going to be looking at our companies for their creditworthiness and make sure that they maintain that. But our focus, again, has been on high-quality issuers. We would look at a recession and, maybe not right away, but ultimately, the Fed likely will lower interest rates. So for the coupons and the income streams that we've locked in at higher rates, that just makes it more attractive if short-term interest rates fall. The other risk that Dan sees out there is inflation. And what we saw in 2022, when inflation spiked at 9%, I'm not sure, Dan, I don't think you put an actual number in your forecast at this point. There's just not enough clarity. Yeah. Anyways, if we see inflation rise, as Dan said, we would expect that longer-term interest rates will rise as well. So for us, we see that as an opportunity to just continue picking up attractive longer-term yields. I think that's kind of what I wanted to hit on, but I just wanted to kind of drive home that we think right now is a good time to be in bonds.
Thank you again, everyone. Thank you, Dan. Thank you, Jon.